Hello and welcome. I'm Jay. This is smarthelping.com, and we're going to go over the oil and gas well financial forecasting model. It's a 20-year model. I'll go through each tab, explain how it works, and then you'll know how to use it. Link is in the description box below, and it'll be listed on all relevant places for vendors and on smarthelping.com. Okay, so global control tab here, you're just defining some high-level stuff, the company name, the launch year, and the end month. The rest of the data on the global control tab is there's some resources here for oil and gas research, some paper, some data of where I got a lot of the information used to build the assumptions. You've also got total activity summary for total contributions, total distributions for the GP and LP. No, it doesn't have to be a joint venture. You could just be an operator and it's your own equity, and that's fine too. You just zero out the LP contributions and profit share on the waterfall tab right here and here. But if it is a joint venture, you'll see the contributions by each, distributions, their internal rate of returns, and the internal rate of return of the whole project, as well as the equity multiple. You've also got the minimum cash position and the sanity checks, making sure the monthly and annual detail cash matches and the executive summary matches the annual detail. These are all the same total data, so they all should zero out. Go to deployment. This is where you're going to spend a lot of time. So you can deploy up to 46 wells, or I should say well cohorts. In each cohort, you can define when the drilling starts, how long you're going to drill for, and this is the exploration period in months. You're going to define how many months the successful drills will produce for, and you're going to define how many drill holes you're drilling with this cohort, the success rate. Based on the success rate, there's the number of expected successful drills. You're going to define all the costs related to the one-time exploration costs, any ongoing exploration costs, and this would populate during this period if there's multiple months where you're exploring the same uh, drill holes. There's the one-time drill cost for a successful find. So this is deploying the extraction equipment and everything required to get the oil or gas or whatever you're pulling out of the ground out. So this is a one-time cost that happens at the end of this period. And then you've also got the ongoing extraction cost. So this is the ongoing monthly cost to continue to pull out the gas or oil. So those all update dynamically and will populate across the useful life of the well, the well cohort, and it'll all summarize into the monthly and annual details, as well as the executive summary. Now, to figure out more about how you're going to make revenue, you have a average selling price per unit. You can put here, you can put the percentage of revenue kept. This is saying if you have to pay royalties to the landowner, then you're not going to get 100% of the proceeds, so you put in your percentage kept there. You've got the average annual price change of the price per unit over time. You've also got the expected initial production per day. So this is going to, based on my research, the flow rate is going to be the maximum rate at the beginning, and then over time it will decline at an exponential rate. So you can define the initial flow rate as well as the expected monthly decline rate of that flow rate over time. Then over here, some ancillary summaries based on your inputs. This shows you what percentage of the maximum you're still producing per month at the end month. And the end month, again, is defined right here. So this would be 110 months drill time for the successful wells drilled. At the end of that month, total monthly period, you're still at 34% of maximum. You're producing 336 units per day on the stop month. Total units extracted over the well life, 3,062,000. The monthly value of units produced, so you're still doing $6.9 million worth of extraction value per month. And then this is going to show you what the gross revenue is, and this simply takes your net revenue your net revenue less your ongoing production costs. So the expected costs per day or per month here against the monthly value of the extraction. So here it's saying it's still profitable at the end of the period. And this will just be a function of this number, the growth rate in price, the decline rate, and the ongoing costs. All of those together will populate this figure, as you can see here. Now the 6.9 million is coming right from the matrix row 446. And if we go to that 446, this is where all the dynamic logic is happening to make sure the deployment assumptions are correctly flowing to the right month. This is where all the magic is happening. So here, value of units produced. So this is taking total. So 397 is total units extracted times deployment M5 times the percentage left, or times the growth factor of price. And deployment M5 would be the price here. So actually, so this is the total revenue before royalties. And then you're taking that times N, so that then accounts for the royalties, minus the monthly cost times the count drill holes. Okay, so that's deployment. You can do a lot of stuff here with, these start months don't have to be in order, but you define any start month for each of the cohorts. You can just do one if you want to plan out just a single item, that's fine. Or if you want to show multiple drilling cohorts over time, you can do that. All these are changeable, adjustable for each row. All right, so once you fill that out, we've also got some fixed costs here. This is to define, running costs for an executive team, managers, any fixed costs over the 20-year period. You can put this cost description, and there's a lot of these, a lot of slots here. You can put in the start month that each cost starts and what that monthly cost is over the period. There's also some catch-all costs here where it's defined as a percentage of net revenue. So that's revenue after royalties, and that percentage will apply to that. You can see that percentage taking place right here in this section. Other costs as a percentage of revenue on the monthly detail, and it takes the gross revenue, so revenue after royalties or net revenue, same thing, times whatever that percentage is. All right, then we've got executive summary. So here you can see a high level over the 20-year period. How many wells have you drilled over time? How many successful wells have there been? What's your total revenue? What's total royalties? What's the net revenue? What are your ongoing extraction costs? What are your ongoing overhead costs? Operating expenses, net operating income. And then here's the big one. These are where the big investments come in. The initial exploration costs, aggregate, ongoing exploration costs. These are not ongoing drilling costs. This is before a successful well has been found. So let's put it down in this section. And then you've also got the successful well deployment costs. All that aggregates into a cash flow that we can summarize here. We've also got some visuals to show net revenue and cash flow. We've also got cumulative cash flow over time. Now the monthly detail, this is going to show you where you've got all of your activity that's coming from the deployment schedule, the fixed costs, all that stuff is aggregating. So you've got your drilling activity here, successful drills per month, explorations drilled per month, active exploration drilling, and total explorations done, as well as active producing wells, which all will adjust over time. And that's all, again, based on the deployment data. You've got your revenue, royalties, percentage margin on that, all your big one-time exploration costs, ongoing costs, and successful well deployment costs and ongoing extraction costs. Then all your fixed cost, operating costs from the fixed cost tab. Here, other costs as a percentage of revenue, other expenses total, and then you've got the cash flow. Now for taxes, there's so many factors with taxes. So what I did is that this is a manual input where the user can just define what the expected monthly costs for taxes are. Likely going to be some combination of, your net revenues. You might have some percentage of the ongoing exploration costs might be tax deductible. Uh, the initial drill hole costs, ongoing extraction costs. But I try to separate these into their biggest buckets so that you can still see which is what, and if you want to, if whatever is tax deductible versus a capital asset that has to be depreciated, you can see that here and fill in whatever you think your taxes are going to be manually. And then we've got the final cash flow. So this just takes, if we go up here, total gross revenue, taking off the total exploration costs, taking off the total expenses, which is just other costs and total fixed costs, and taxes. And then that's where we get to cash flow. And you can see this is just totaling these two. So you've got cash flow, cumulative cash flow. This is where you can see, assuming you kept all the cash in a single account, then the minimum cash required is the lowest that this value gets over time on a monthly basis. And I aggregated that here. So you can see 313 million is the actual low. It's saying here you're going to have 397 million deployed by the LPs, 434 million by the GP, 440 million total. This is assuming every negative cash flow month is a contribution, and then any positive is distribution, and there's no capital accounts being held. So it's just, here's the total negative cash flows and here's the total positive cash flows. Now, if you net them together, the number is going to be the same as if you just deployed this much capital and you use some of the ongoing profits to fund future deployments. But if that money was being withdrawn and distributed, you wouldn't have it. So you would have this as your total distributions. I do think this number is valuable just to see, because, if you were going to maintain a capital account, then you could, that would give you your actual minimum cash that should be invested net, and it means some of your distributions would just be reinvested rather than distributed out and then have to be reinvested from there. This is the simplest way to, I know it kind of sounds complicated, but this is actually the simplest way to really see what is happening with the cash flow. There's some key metrics here: average gross revenue per well, average net revenue per well over time. So it's just taking your active existing wells against the gross revenue that those are producing. Net revenue is also taking into account the ongoing extraction cost before it does the calculation. Then you've got your success rate on wells and an IRR here. This is taking the all the monthly cash flows and converting that into an annual internal rate of return. If we go to annual detail, it's the same exact data, but on an annual basis. So you can see it just goes out for 20 years. And you've got all the same data here, but these are now annual values instead of monthly. And like I said, on the deployment, this doesn't have to be all filled out, and you also don't have to run the model for full 20 years. You could run it for any amount of time. You could run it for 10 years or what have you. 5 years, just it is arbitrary. Whenever your end month is selected, that's just when everything stops. For this note, there's no debt. The reason why there's no debt assumptions is because it's very hard to get regular financing from a bank for drilling. Usually, from what I read, there isn't a whole lot of options. You're just going to have to raise equity to do this kind of thing. Now, there's probably exceptions to that, but for that reason, there's no options for raising money through a traditional bank in this model. It's all equity. Where were we? So annual. So the waterfall here, again, you could define any contributions. The LP is going to contribute 90% in this case. GP is 10%. This is adjustable. It could be 80, 20. 90-10. You can see how the equity multiples and IRRs will change based on that. And then this is saying up to each internal rate of return hurdle that the LP receives, the cash is split at this rate. Now, if it was a hard preferred equity, you could just put 100% for the LP, and what that means is they get all of the cash flow that's distributable until they've received a full 7% internal rate of return. And to receive that, they would have to get all their money back plus have a compounded 7% annual rate of return. After that, from 7 to 15, they're now going to, in this case, with the assumptions you see here, they're going to split with the GP at 70-30 cash flows, and then anything over 15%, they'll give the GPs a little bit more of a boost here. Now they're getting 35%, 65, and then over 20%, they're going to go 50-50. Now these terms can be, there could be more hurdles, less hurdles. There could just be a single hurdle. If there is just a single hurdle, that's fine. Like if it's 7%, you can just put that here. And then just say after that hurdle, what's the split? Is it, it could be 50-50 the whole way. It could be 0. In that case, you're just saying the LP gets their rate of return, and then that's it. Now this is an annual rate being converted to a monthly, so you can see the actual exit IRR is slightly different than this 7%, and that's just because we're doing a monthly conversion of the annual internal rate of return. But that's completely fine for the purpose of the model. But if you could have this be, let's say you have no hurdles. Let's say the equity contribution is 100, or let's say 90-10. And then you're going to split the cash 60-40. That's fine too. Whoops. You can just put 60-40 no matter where you're at. That's how much cash is being split. So this is a dynamic waterfall. You can handle a lot of different things. Let's just put this back to pari passu. So 90-10 up front, and then 90-10 up until the hurdle rate, and then there's promotes for the GP after that. So this is just a common style you might see. These rates are all, this is all negotiable. This will all be in the operating agreement when you try to figure out how to get the deal done. Now there's also discounted cash flow analysis down here based on a discount rate and all the cash flows for the sponsor and the investor, or sponsor also is the GP. You get a net present value, and note the internal rate of return. If you plug that in to the LP, that would give you a 0 NPV, and that's the definition of internal rate of return. So same with the, if I took this GP cash flows or internal rate of return, plugged it into there, NPV 0. Okay. Annual waterfall summary is just showing you the same data, but now you can see on an annual level, here's what the sponsor GP is contributing and receiving back. Here's what the LP is contributing and receiving back. Here's the total cash flows and cumulative cash flow for each, as well as a chart to show that. Now you can see there are some negative cash flows a little bit happening here at the end. That's just saying at the end, we're running this thing to the very last month, but our wells are only running for 110 months. So if we look at our monthly detail and go to the very last period, it's at month 232, all the wells are actually done. So you would probably pick the March 2042 as your end month of the forecast, and that would just stop all these other ongoing costs if you want to get a perfectly accurate forecast based on your assumptions. Visualizations, lots of visualizations here. So units sold per year, total, gross revenue per year, cash flow, average net revenue per well, and this is an annual, average drill success rate, annual initial deployment costs versus ongoing extraction costs. So the bigger negatives are like the one-timers. That's ongoing. You see the difference. Active drill exploration versus active producing wells. So you can see we're only doing this for 10 years of drilling. Then we stop doing that, and then that's when you see things start to decline. And we've stopped drilling. We're just collecting whatever's remaining based on the decline rates of in the production. That you can see how this drops. Now, if we were continuing to do wells all through, let's say we did one every 12 months, then we could probably, it'd be a more even uh, forecast as far as the full 20-year period. But here we're doing a lot up front and then start to fall off. But this is completely up to you, and that's the reason why I made this so dynamic and granular. Is you can basically plan any kind of strategy here and see what the financial effects are. Successful drills versus total explorations per year. So there's a 15% rate on all of them. So that's what your ratio you're seeing there. Total explorations completed. Here's I did the first 5 cohorts and how much they're producing over time in units. So monthly units produced by well cohort, and this is just your exponential decline curve happening. And then this is the same thing, but the value of that, the value of the units over time. Now these big drops here, this is, I'm assuming this is just a lower month because it is based on the days in the month. So 0.26 well A, let's look at that real quick and just see. I go to my matrix, well A, period 26. What is period 26? Do we have 1, 2, 3, 4, 5? Yeah, so you can see that's a low. You got 2,082,000, then 1.9, then 2.1. So 26, I'm assuming that's a February. Yeah, look, see, that's in 28 days. So that's why you see those dips. It's just showing you the month where there's less days in that month. So there's that. And then the curves, again, that like this is showing your exponential decline curve of each well cohort, and that will adjust if you change column Q here to some other number. That'll be different depending on each well in your specific situations. Matrix tab, this is where all the magic happens. There's lots of logic happening here. An example cost, this is where you can put in the, we've got initial drilling costs, ongoing costs. These are not detailed out, and the model is just one total for each item that you input on the deployment schedule in this section. But if you want to see for yourself what each cost is made of, you can put that data here just so you have it and can reference it. But I didn't want to put this many schedules 47 times. It'd be too cumbersome for the model and the purpose of it. So I just put in an example. These numbers don't flow anywhere. All right. Well, I know it's a longer explanation video, but this is a really awesome template for forecasting oil and gas production over time. And I think it's done very well. It took 3 weeks to build across 6 streams. I built the whole thing live, and I think it's really, really good at doing what it's built for. You can check out more templates at smarthelping.com. Like the video, subscribe, and I'll see you guys on the next one. I always take suggestions as well as I do provide custom work for $165 an hour. You can email me about it. Take it easy.